Hello and welcome to this section 1.2 of Part A of Module 1 of Digital Finance. Here we're looking at the impact of technology on the digital finance landscape. And the first thing I want to highlight is this year has been an interesting year with Bitcoin, especially with Elon Musk. And earlier in the year, Elon Musk announced that they were going to accept Bitcoin as payment and cryptocurrency. And this is quite a fascinating strategy, and partly it might just be to stir up the market, partly to just have a lot of fun, or it might be a deliberate and genuine strategy, because after this announcement was made, a lot of other companies decided it was important to have Bitcoin on their balance sheet. It was important to accept payment. And the key concept introduced in the section is, do you have competitive advantage or transient advantage? So competitive is this idea of sustainable, ongoing advantage. That's when you have like a patent, a license, a copyright, something that can't easily be reproduced. Or is it transient and anyone can easily copy? So when Tesla did this, what should you do? As a finance professional, if you're advising an organization, would you encourage them to purchase Bitcoin and have it as an asset, knowing that 2021 has been the most volatile time for Bitcoin and its prices? Should you use it as an investment? Should you be storing spare cash in it? Should you accept cryptocurrency payments, knowing that they're open to fraud or abuse or being lost very, very easily, and the value of the amount is incredibly volatile? What would you advise to your board of directors? And how can you be prepared for a future full of these technical innovations? And how do you stay on top of these changes that just keep on rolling on? So in this section, we introduce the idea of the digital finance cube. And it's a great image for piecing together all the concepts you're going to cover throughout the study guide. So we dip into a couple of these now, but they are explored in more detail in later modules. So there's three key components you can see at the front. There's the business functions in the dark blue, and then there's the technologies, the light blue, and the digital finance institution. So I want to just give a little tour of a few areas and explore them. So dimension one, digital financing. What does this mean? Well, the best thing to do is give you a couple of examples. And for those of you who've used Xero or heard of Xero, the accounting software, you can think through the logic or the power of this business model. So it says their advertising spiel, Xero is your best asset when applying for a small business loan or finance. And you think, well, why? How? How does digital financing work here? Well, if you're going to key all your accounting data into the system, Xero then runs an algorithm to determine if your loan amount is a little bit too small, or if your cash balance is a little bit too small to pay off all of those creditors. So before you even know it, Xero is saying, hey, do you want to borrow some money? And they can say, we can process this quickly. Instead of you filling in a detailed form and going to the bank and wasting a lot of time, we already have all your data. We know how regularly your customers pay. We know when you have to make payments to your suppliers. And so we can share this data immediately with the lender and get you an approval very, very quickly. And not only can Xero do that, it can link you to different groups. So invoice financing is a type of digital finance, and that's discussed in the study guide. So instead of waiting till you get paid, these organizations will pay you now, and then when the money gets paid, they will collect their cash later on. So invoice financing can be very clever. You can see here, one of them's offering up to $300,000 worth of flexible line of credit. So that could be fantastic. But I also want you to think about the negative repercussions that might happen. If Xero knows when you need money, it might know when you're in serious trouble. And if you're in serious trouble, what do they then do to these lenders? Do they tell them you're in trouble and you can't pay it back, or you're falling apart? Or if you think into the long term, what if someone had access to that Xero data and knew all about your organization? That can be a little bit scary and a little bit intimidating. So there is some risk management required there. And there is a dark side to a lot of these digital finance tools. The digital finance tool itself is not normally bad or wrong, but it can be used in a way that's a little bit dishonest or dodgy or leads to problems. So Greensill is an example, and they're doing sort of invoice financing as well, but they were a little bit clever, creative, whatever it was. They changed the model. They did supply chain financing, factoring, $143 billion worth of financing. We're not talking small amounts here. 10 million customers, 175 countries, except The problem is it's all gone upside down. And a key reason why it was the insurers were no longer confident that when the invoice financing took place, that the money would ever be collected. And so the organization and its structures has collapsed with lots and lots of trauma unfolding. And they had a special model. This was called debt was owed by the company, not the supplier, allowing the company to extend and alter repayment terms. So what we have here is when you get a little bit creative, it's easy to win customers when you take on more risk, but don't recognize that risk and don't control for that risk. So you should read up on Greensill, should read up on Xero and the other organizations that do this sort of invoice or factoring or discount factoring, whatever it might be, as a good example of digital finance, but keep in mind the risks. Then we have digital insurances as another example. There's other ones. Digital investments, digital money and digital payments are covered in great detail in Module 2. So skip those to there. But digital insurance, and the example given is Friendsurance. So the German organization. And this is, they call it a customer-centric digital insurance solution, which always sounds a little bit fluffy to me. But what do? Going back a decade, they introduced peer-to-peer insurance. And we look at peer-to-peer in the next section as well. Since 2017, they've been doing these types of business insurance as well. But one of the key things with this platform is if you link family and friends together, you can self-insure to a certain extent. So if you have enough people, let's say 20 or 30 people, maybe 50, well, of all those 50, let's say you're going to insure your cars, only 1 or 2 of you may have an accident in a year. So if you all pool your money, instead of giving it to an insurer, you can let it sit in the pool, and for small claims, you can pay it out as well as take out a larger policy. So one of the benefits of doing it amongst friend and family is people don't cheat their friends and family as much. They're not going to launch a false claim or a manipulative claim. So it links to, first of all, getting insurance where you might not otherwise be able to do it. It lowers your premiums. You can all work together to take on those smaller expenses. And then if something really goes wrong, you have the back end major insurance companies to work together. So that's just an example of it in action. Now we've looked at that first section of the cube. Let's have a look at some of the technologies. Now, once again, these get explored in a lot more detail, especially things like blockchain and cryptocurrency, which is a sort of derivative of that, and peer-to-peer. I want to give you just a quick example because people have heard of blockchain and cryptocurrency, but you can use it in a lot of different industries, including real estate. So buying real estate and using blockchain is a way of having an independently verified transaction. So it means if you buy a property, it's actually, you obtain the title. It's not owned by a different person, or it's not sort of taken out from underneath you. And, title to property is incredibly valuable and important. So blockchain, in the first few steps, the property search can be done through a blockchain-enabled MLS. So you can make sure that whoever claims to own it is the genuine title holder. As a simple example, imagine you thought you were buying a property from someone, you hand over lots of money, and it turns out later on that they didn't even own the property. They have literally defrauded you. So then you can do step 4. There's steps that happen where blockchain is useful. It's step 4, pre-lease due diligence. And from there, the lease agreements are created and automated payments can take place through smart contracts. And finally, you can do real-time data analysis. So if you want to explore blockchain and real estate, the link is on the screen there. And you can just see these kinds of digital finance technologies are applicable in a lot of unusual ways that you might not have thought of. Another interesting industry is the travel industry, because have someone actually paid for their accommodation and their flights. So all of these entities selling travel services, blockchain is a way of confirming in a trustworthy way, because that's what we want. We want trust in transactions because we don't want to be defrauded. Then dimension 3, there are the traditional providers and then the upstarts, the fintech companies that are coming on with new innovation, trying to take on the bricks and mortar banks and looking at the relationship that these two have together. And a good example here is in the past, if you wanted to raise money, you had to go to the share market, to maybe fund your business, or you went to the banks and you borrowed. But crowdfunding is a great example of obtaining money from a lot of investors in a different way. And Brewdog is very interesting. We've actually got a short clip you can watch that's very well put together in the system. They raised £26 million, probably 60 or 70 million Australian dollars, over 1,500 investors. And you can see they're only trying to get £22 million. So they've got £4 million more than they needed or are aiming for. And they're going to use this to invest in more facilities, brew more beer, sell more beer, build their brand, and everyone seems to win. You get to invest, you get to drink beer that you like. Those investors, the company owners, are able to grow the business and produce more beer than they ever thought was possible otherwise. So they've only been around 10 or 12 years. And over the last 6 years, they've grown and grown. They've got a brewery in Scotland, I believe. Then they moved to one in the United States, moving on to Australia, 50 bars as well. So with all this funding, they can open more bars. And those bars, of course, are going to sell these beers. And they've got themselves to number one in the United Kingdom. So the interesting thing, as you go through this example, and here's the clip that you can watch, over 11 years, they've grown rapidly. But the only thing I want you to investigate is, did the people who bought equity through the crowdfunding model benefit just as well as the institutional investors or not? Because sometimes there's a little bit of hype and a little bit of excitement, but you might also be taken for a ride. That's the risk. And like a lot of things in digital finance, the idea itself is not good or bad. Like crowdfunding is neutral, but it can be used for good, but also not always. People can be taken advantage of in the crowdfunding space. So, and this is one thing everyone seems to forget. I'm a little bit of an old school accountant. So I'm a little bit conservative, a little bit prudent. I like to do my risk management. And at the bottom of their little brochure, after an amazing video making it look very inspirational, it says investments of this nature carry risk to your capital. Illiquidity, which means you can't sell those shares, you might never get anything back. There may not be a dividend, and dilution. That means they can issue more and more shares and dilute the value of your shareholding. Balance your risk with a diversified portfolio. So don't spend too much money on us because it might all disappear. And it's been approved as a financial promotion. So there are risks. Just like when people get excited by cryptocurrency and invest like crazy, you have to keep in mind that not everyone is going to be a winner and that there are people out there looking to take advantage of others. So we're going to explore this cube in more detail in all the other modules and some of the examples. There's cryptocurrencies, Xero as an accounting software provider. I've given some examples on ING, blockchain, and others. The next section in the study guide goes into innovation and the 10 key areas of innovation. And so an example we want to use, and it's slightly digitally in its sense because it's online and it's a business model, but it's also just a demonstration of innovation in practice. So we're going to look at flexicar.com, and we actually have a separate recording of this, and it ties in very similarly to, because this section is looking at ecosystems, and GSL also looks at similar kinds of concepts. So we look at 10 areas of innovation, initially invented or described or theorized by a fellow called Doblin, and then consolidated into a book. Most people innovate by changing the product. I'm going to add a new feature to my product, or they add some more customer service. But what we forget to do is look at the profit model. How can we change the way that we buy or sell? We might license it instead of selling. What's our distribution network? What's our structure of doing work? What are our processes and product performance like? So as I said, most people pick product and they innovate there. But there are many, many other areas, including the brand, the channel, the service. And so, and finally, customer engagement. So the research had shown, though, that the financing area with new models and new innovation is where a huge amount of this improvement in value add is coming from, which is really exciting. And if you actually look at product variation, even though that's where we hear about most innovation, that's not where the value is being created. So it's good to think about how innovating in the financial realm doesn't change the underlying business or the product or the service that you offer, just the systems, the efficiency, the speed, the customer experience of getting the work done. So when you're in the system, have a look. There's about an 8-minute clip that takes you through this, the 10 areas of innovation to help you understand these concepts more clearly. And Chris explains that in relation to FlexiCar. And if you remember back to my introduction to Module 1, I talked about this finance hub. And this organization was a company that had invested heavily in the product itself, a typical example of innovation. And yet now this finance hub is an investment in innovation for the financial area. And they're aiming to generate $30 million in savings per year through cost efficiencies. So it's an incredibly powerful tool. So I hope you found that a useful overview of this section, and keep up with your reading, make sure you write an index, make sure you take your own summary notes to keep on track. Thanks.